Retirement tax planning isn't annual, it's monthly. Most retirees think about taxes once a year, typically when they file in March or April and they're reacting to what happened in the previous year. But the retirees who pay the least in lifetime taxes don't plan annually. They plan month by month. In retirement, your income is flexible. Your withdrawals are optional. Your timing decisions matter a whole lot more. And because taxes, Medicare premiums, and Social Security all interact with each other, when you take income can matter just as much as how much you take. Today, I'm going to walk you through the tax planning calendar every retiree needs in 2026, a practical month-by-month framework that shows where Roth conversions, capital gains harvesting, Medicare deadlines, charitable giving, and withholding decisions actually belong on the calendar. But before we dive into all that, my name is Ryan Knoll. I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm where my team and I help clients nationwide make smart money decisions. Let's jump into the video. While you were working, taxes were largely automatic. Paychecks arrived, withholding happened, and planning opportunities were limited. In retirement, you control a whole lot more, specifically which accounts you draw from, how much taxable income you'll generate, when capital gains are realized, when Roth conversions occur, whether Medicare premiums spike later, and whether your Social Security becomes taxable and at what percentage it becomes taxable. But that flexibility cuts both ways. Without a system, retirees often stack too much income into one year, trigger IRMAA without realizing it, miss optimal Roth conversion windows, forget Medicare and Social Security deadlines, and overpay taxes simply due to poor timing decisions. A calendar turns tax planning from reaction into strategy. All right, so let's jump into the calendar now. So it's January or February. Now's the time when you want to set the guardrails. The first 2 months of the year are about clarity and positioning, not execution. This is when retirees should review their income from last year, identify tax bracket targets for 2026, identify IRMAA thresholds for 2028, because remember there's a 2-year look back when it comes to IRMAA surcharges, set Roth conversion caps for the year, and then coordinate withdrawals with upcoming spending needs. January is also when retirees should think about when they should confirm their required minimum distributions for the year if it applies to you, verify withholding settings from pensions and IRAs, and decide whether estimated quarterly payments are needed so you don't end up paying penalties on the taxes that you owe. The biggest mistake retirees make early in the year is doing absolutely nothing, then scrambling in November to fix taxes that were baked in months earlier. It's really important that by the end of January, you know how much income you will take from your accounts, how you will pay taxes on that income, and what tax bracket you will be in, and how much room then you'll have for Roth conversions, if any, at the end of the year. Setting the stage like this will do two things. First, it'll provide you a roadmap, and more importantly, it'll help you to understand how much wiggle room you have should something unexpected comes up. Because as we all know, life happens. This will help you to mitigate taxes and know what your built-in safety net is so you don't wind up paying Uncle Sam more in taxes and penalties than you have to. All right, so now we're going to move into March and April. So it's time to file your taxes and then plan forward for the rest of the year. Tax season isn't just about filing, it's about learning. Once your return is prepared, this is the best time to analyze things like your effective tax rate, the marginal bracket you ended up in, whether your capital gains were taxed at 0, 15%, or more, whether Social Security was taxed more than expected, and where you fell on the IRMAA thresholds and whether you triggered IRMAA surcharges. With a completed return, retirees can now adjust Roth conversion targets, adjust withholding for the rest of the year, identify opportunities for multi-year planning, and decide whether a partial Roth conversion already makes sense. If you wait until December to evaluate, you've lost most of the flexibility the year offered. This will also let you know how efficient your plan was the prior year. If you see that you used tax brackets effectively, didn't trip IRMAA, and still had some room for Roth conversions, that's a pretty efficient plan. If you find that you weren't quite that efficient, you still have some good news here. You have an opportunity for some massive tax savings this year in 2026. If you feel lost at this point, this is when you should reach out to a financial advisor or a financial planner. It's still early enough in the year that no damage done is catastrophic. It could also potentially be reversible as well. So reach out to a planner if this is you and have them walk you through a concrete plan. Preferably you reach out to us here at NavWealth via the link in the description below, and we would be more than happy to help you get back on track. All right, so now it's May or June and we're reaching the halfway point for the year. This is your Roth conversion execution window. And for many retirees, late spring and early summer are ideal for a portion of your Roth conversions. Why? This is when you have visibility into year-to-date income, Markets can experience volatility that temporarily lowers account values, which could make conversions more advantageous, and there's still time to adjust if income changes later on. This is when retirees should begin partial Roth conversions up to a predefined tax bracket, monitor your modified adjusted gross income relative to the IRMAA thresholds, and spread conversions over multiple tranches instead of in one lump sum. The goal is not to convert as much as possible. The goal is to convert efficiently without pushing income into unnecessary taxes for Medicare penalty zones. Let's say you're tracking to have the capacity to pull $50,000 from your IRAs for Roth conversions. At this point, it might make sense to convert $20,000 or $30,000 of that money over. This will allow you to get more money into Roth sooner, but still give you plenty of wiggle room should a life event pop up and you need some extra money. Then at the end of the year, this is when you convert any amount left over that was unused. So in the example, let's say you converted $30,000 of your $50,000 allotment for the year to Roth at this point. But then later in the year, you needed $15,000 to fix your leaky roof. You would still have $5,000 left over for Roth conversions to use by the end of the year. And that leaky roof is exactly why we don't do the conversion all halfway through the year. Because if you did it all at that point in time, now you're pulling out an additional $15,000 worth of income potentially to cover the cost of your leaky roof, which pushes you into higher tax brackets, resulting in paying Uncle Sam more and potential IRMAA surcharges. The next thing you want to do is look at your capital gains and income balancing no later than July and August. Mid-year is the ideal time to evaluate capital gains harvesting and taxable account strategy. This is when retirees should review unrealized gains in taxable accounts, determine how much gain can be realized at the 0% or 15% capital gains tax bracket, and use taxable account basis to fund spending without increasing adjusted gross income. You also want to pair your capital gains harvesting with Roth conversions carefully. Ideally, your advisor is automating tax loss harvesting and capital gains realization for you. But if you're manually tracking this process, you want to start looking for opportunities to do so no later than the start of the third quarter. A key concept here is income stacking. Every dollar of income interacts with every other dollar. Poor coordination can turn low tax strategies into high tax mistakes. Summer is also a really good time to reassess estimated tax payments, adjust IRA withholding if needed, and check in on Medicare thresholds. Essentially, this is the halfway point of the year, a little bit more than the halfway point of the year. Let's make sure you're tracking to execute your plan perfectly. Now it's time for your Medicare planning month, aka September. And September is when retirees should turn their attention to Medicare implications, even if enrollment changes happen later on in the year. This is time to project your final modified adjusted gross income for the year, evaluate whether IRMAA thresholds are at risk, decide whether additional Roth conversions still make sense, but hold off on doing them until closer to the end of the year, and determine if income needs to be deferred or accelerated. For retirees approaching Medicare eligibility, September is also when to confirm enrollment timelines, coordinate employer coverage, COBRA, or ACA plans, avoid late enrollment penalties. Specifically, Medicare planning is not separate from tax planning. It's an extension of it. Treat it as such. Now it's prime time for charitable planning, especially for retirees who give regularly. It's the month of October. This is when you want to decide whether to bunch charitable donations into one year, whether to use a donor-advised fund, whether qualified charitable distribution should replace IRA withdrawals, and whether you should itemize your deductions this year or claim a standard deduction. For retirees taking required distributions, this is when your QCD strategy becomes critical. QCDs must be completed by December 31st. They directly reduce your taxable income, and they offset your required minimum distributions from your IRAs dollar for dollar. Waiting until December risks processing delays and missed opportunities. Don't let that happen to you. November is the last call month when all projections must become decisions. This is when retirees should lock in Roth conversion amounts, complete remaining capital gains harvesting, finalize charitable gifts, adjust withholding to avoid underpayment penalties, and confirm required minimum distributions have been satisfied for the year. This is also when retirees should stress test final modified adjusted gross income, the final tax bracket they'll end up in, whether they tripped an IRMAA surcharge, and what their Social Security taxation threshold will be for the year. The goal is to enter December with no surprises left, just small moves you can make to maximize your results for the year. Now we roll into December, so as you should be getting ready for holidays and the new year, this is not a planning month, it's an execution month. Key actions here include completing Roth conversions, finalizing your qualified charitable distributions, taking any leftover RMDs for the year, locking in your withholding adjustments, and harvesting last capital losses and gains if applicable. December is also when retirees should review next year's expected income, anticipate upcoming Medicare premiums, identify whether January income should be delayed or accelerated in order to maximize the one last point of the year when it comes to your income realization. Essentially, the biggest mistake, though, that retirees make in December is trying to create this strategy under pressure and trying to do it in a condensed time frame when we're all getting ready to celebrate the holidays with loved ones. If the calendar was followed earlier, December becomes really simple and efficient. So one often overlooked tactic that we use for our clients here at NAV Wealth, and I think that deserves a special mention, is IRA withholding. Unlike estimated quarterly payments, withholding from IRA distributions is treated as if it occurred evenly throughout the course of the year, even if it's only done in December. This allows retirees to correct underpayment issues late in the year, avoid penalties, simplify cash flow management. For many retirees, strategic withholding is the cleanest way to manage taxes. Just make sure that if you're completing Roth conversions, you're not withholding taxes from those conversions. Those taxes should be paid from cash on hand or from your taxable brokerage account or as part of your estimated tax payment schedule so you can get as much money into the Roth as possible. You want as much money going into your Roth, and withholding through the conversions will not let you do that. So we follow this calendar-based approach with our clients here at NAV Wealth, and it does three things exceptionally well. First, it prevents income clustering. Next, it minimizes Medicare premium surprises, and it creates repeatable low tax years. Instead of guessing, our retirees operate with defined income targets, known tax brackets, controlled conversion strategies, and predictable healthcare costs. This is how retirees create long stretches of low or even zero tax years, not by luck, but by design. Let's just go through a simple, brief example. So consider a retiree couple who has $1.3 million in their IRAs, $500,000 in taxable brokerage accounts, and they're planning to delay their Social Security. Using a tax calendar, they convert $40,000 per year in May or June. They harvest capital gains in July at a 0% rate. They use taxable basis for spending. They execute qualified charitable distributions in October once they're eligible, or that's what they're planning to do. And they're finalizing their withholding in November. And then in December, they can just look to see what is unused and where they can pull little strings to optimize more. So essentially, this is when we would look to see, can they beef up their Roth conversions a little bit more, maybe do some more capital gain harvesting at low income tax brackets or at 0% rates. Lower required minimum distributions later on. There's controlled Medicare premiums. There's predictable tax brackets, and there's no April surprises. Same assets that they had they not had the plan, but with an entirely different outcome had they not done any pre-planning. The bottom line here is retirement tax planning doesn't happen once a year. It happens every single month. A calendar turns taxes from a reaction into a system. It keeps income smooth, premiums predictable, and decisions intentional. If you want help building a personalized tax planning calendar, one that integrates your withdrawals, Roth conversions, Medicare planning, Social Security, and charitable strategies, that's exactly what my team does here at NAV Wealth Partners. And if you're not ready to meet yet, don't forget to throw us a like and subscribe to the channel. We'd love to see you back here. Thanks so much for watching, and as always, make smart money decisions.